I want to kick the program off today talking about the current state of the housing situation here in Canada because, of course, everybody needs a place to live, whether you own or whether you rent. And CREA, the Canadian Real Estate Association, has revised its housing forecast for the rest of 2024. And what they're saying, they have scaled back their predictions, and they're saying that due to a higher supply of homes and fewer expected rate cuts, they're cutting back on their predictions here. We did see a 3.7% increase in June sales from the previous month, and CREA now expects a 6.1% rise in property transactions through the course of the year, but that's down from the 10.5% that they had predicted back in April. Sean Cathcart, he's CREA's senior economist, and he said that June wasn't an exceptional month. It wasn't a blow the doors off month by any means, but Canada's housing numbers did perk up a bit on a month-over-month basis in June following the first Bank of Canada rate cut. So even though there was a 9.4% drop in home sales compared with last year, prices did see a small uptick, which is the first in almost a year. The average home price in June was $696,179, which is down about 1.6% from June of 2023, up slightly by only 0.1% from May. Now, TD economist Rishi Sondhi is optimistic about the rest of the year, and he says this could be a harbinger of improved activity ahead. Indeed, we think that markets will be stronger in the back half of the year as the economy holds up and more meaningful interest rate relief is delivered. That being said, he did warn that affordability issues could limit how much the market improves. CREA, they're now forecasting a 2.5% increase in average home prices for 2024. That's a downgrade from their earlier predictions of about 4.9%. Now, the Bank of Canada, of course, in case you're not up to date, they made their first rate cut in this latest easing cycle back in June. They lowered the key interest rate to 4.75%. And BMO senior economist Robert Kavchuk, he noted that the market didn't react immediately to this change, as a lot of people expected. He says, all told, the resale housing market was subdued across much of the country in June, with little major response to the initial rate cut of this cycle. Now, John Lusink, he is the president of Right at Home Realty, and he says that he expects further rate cuts this year could boost market activity a little bit later in the year. And he says that if the rates are significant enough, he says that we could see a bit of a surge in activity by mid to late Q4. From a macro view, there were about 180,000 properties that were listed for sale across Canada at the end of June. That's up 26% from last year, but still below the historical average of around 200,000. New listings, they grew by 1.5% month over month, especially in the Greater Toronto area, the BC Lower Mainland. And Lusink noted that buyers and sellers are currently in a standoff. He says you've got sellers sitting on one side, buyers on the other, and the two aren't meeting in the middle. It's sort of a holding pattern. BlackRock, which is the world's largest money manager, they hit a new milestone recently. In the second quarter, their assets under management grew to a record $10.65 trillion. And the company attributes this growth to rising client asset values, significant investments into their new ETFs. As you're probably aware, the stock market has been on quite a bit of a roll recently. A lot of that driven by the potential for a U.S. soft landing, but also mostly because of the interest in artificial intelligence stocks. We've seen a large growth there. And this has contributed to BlackRock's assets, which increased from $9.43 trillion a year ago. And the company's revenue, it's heavily relies on its fees that it earns from managing and servicing these client assets. In the quarter, BlackRock saw total net inflows of $81.57 billion. That's up slightly from the $80.16 billion they saw last year. The bulk of this came from exchange-traded funds, or ETFs, with $83 billion flowing into ETFs. And this makes it now their best start to a year on record. Investment advisory and administration fees, which are typically a percentage of the AUM, of the assets under management, those rose by 8.6% and came in at $3.72 billion. And also revenue from their technology services, that grew by 10% to $395 million. And that's thanks to a continued demand for their investment risk management platform, which is called Aladdin. Overall, BlackRock's total revenue increased by 8% to $4.81 billion. Net income was up to $1.5 billion, or $9.99 a share. That is up from the $1.37 billion, or $9.06 per share a year ago. A bit later this year, Harvest ETFs will be marking its 15th anniversary as a company. And since Harvest began offering income ETFs, they have paid out nearly $1 billion in total distributions. I'm going to put a link in the description of this video. You can find out more details there. Well, they've now just announced their latest round of distribution increases as this crucial part of their core ETF's total return to unit holders. The new monthly cash distributions will take effect for the July 31st, 2024 record date, payable date of August 9th, 2024. So why are they doing this? Well, the increase in the distribution amounts, this is intended to provide a reasonable and sustainable distribution yield for the unit holders of their ETFs. At the same time, though, they want to continue to provide the opportunity for long-term capital appreciation through exposure to the investment mandate of each of these ETFs. Michael Kovacs, he is the Harvest president and CEO. He says, Harvest takes pride in our ETF's long-term record of steady monthly cash distributions, and we are pleased to announce these increases as an important part of the ETF's total return to unit holders. Later in 2024 will mark the 10th anniversary of the Harvest Healthcare Leaders Income ETF, HHL. Over nearly 10 years, HHL has paid out $450 million of steady monthly cash distributions as of May 31st, 2024. So if you're looking for cash flow into your portfolio, this is a great opportunity. As I said, I will put a link in the description of this video. Shares of Trump Media and Technology Group were up around 50% when the markets opened this morning. And this, of course, comes in the wake of the attempted assassination of the former U.S. president over the weekend. This now marks the biggest single-day gain in the company since they launched back in late March. As a result of this, the value of Trump's stake in the company, which owns Truth Social, has gone up. At these opening prices, Trump's 114.75 million shares are now worth around $5.6 billion. That's up from around $3.5 billion before this incident occurred. Now, the shares have retraced a little bit after the markets have settled in, around 33% up today at the time that I'm filming this story. Now, Trump Media, this is often considered a bit of a meme stock, and it trades more on momentum and hype rather than the actual solid fundamentals of the companies. Matthew Tuttle, he's the CEO of Tuttle Capital Management, and he commented on the situation saying, "You are seeing the Trump trade on steroids here. DJT is the go-to." Investors seem to be betting here that the chances of Trump winning the presidency in November have increased following the assassination attempt here. He is expected to formally accept the Republican nomination for president at the convention in Milwaukee, which actually starts this week. The company itself has really generated very little revenue, and Truth Social really remains a pretty minor player in the social media world. But Trump's company, trading under the ticker DJT, has seen its valuation go up, as we talked about this morning. Recently, shares of Trump Media have been added to both the Russell 1000 and Russell 3000 indices, and that means that many of the retail investors now own shares through mutual funds or exchange-traded funds. And in this aftermath of the events that we saw at the assassination attempt, it just sort of highlights the volatility, the speculative nature of DJT, and it underscores how these political developments can so strongly influence market behavior, especially when they involve these high-profile figures like Trump. What you're seeing on your screen here is a scrolling list of my current top holdings. This is a screen recording from my Blossom Social account. If you want to dig a bit deeper into mine or over 150,000 other members' portfolios, you can click on the QR code you see on this screen. Look up my profile, Mark B. Start your Blossom journey today. U.S. steelmaker Cleveland-Cliffs, they announced this morning that they are planning to acquire Canadian steelmaker Stelco Holdings for around $3.8 billion Canadian. And after the announcement, shares of Stelco were trading up about 72% this morning. This is now Cleveland-Cliffs' first acquisition since it tried unsuccessfully last year to buy U.S. Steel. According to the company's CEO, the deal is advantageous because Stelco's existing operations offer a lower cost structure compared to building a new mill in the U.S. The company expects this buyout to positively impact the per share profit in 2024 and 2025. So the deal itself, it involves Cleveland-Cliffs' offering of $60 in cash plus 0.454 shares of its common stock for each Stelco share. That will total $70 per share. This is a huge premium as Stelco's shares closed last week out at $37.36 Canadian. The transaction, it's expected to finalize in the fourth quarter of this year, and it has garnered support from David McCall, who's the international president of the United Steelworkers Union. He says that the acquisition is a strong step forward for both companies. Now, as I kind of alluded to last August, Cleveland-Cliffs made an unsolicited $7.3 billion offer for U.S. Steel, but U.S. Steel did reject that bid. They said it was unreasonable, and they chose to merge with Nippon Steel for $14.9 billion instead. Now, as far as it affects us here in Canada, Stelco operates 2 Ontario locations. They have a steel-making facility at Lake Erie Works and a finishing and coke-making facility at Hamilton Works. Upon completion of this acquisition, Cleveland-Cliffs shareholders will own 95% of the combined company, with Stelco shareholders still holding on to the remaining 5%. And importantly here, Stelco will continue to operate as a wholly owned unit. If you're not subscribed to our Pulse newsletter, I'm going to make that easy for you here. Go ahead and click on the link in the description. I'm here Mondays and Wednesdays with this report. As always, thank you so much for watching. We'll see you Wednesday.